Dear learners, welcome you all to the third semester class of financial management. And today we are going to discuss about the fundamentals of financial management. What is financial management? Why financial management is required or essential, and all that thing. Now, when we are talking about financial management, what do we mean by the financial management? So if you see the definition or the meaning of a financial management, it is basically a management of flow of funds. So whenever we are trying to manage the flow of funds, and accordingly to that, if we try to look over the different aspects of funds, the sources of funds, the use of funds, and which is finally again helping us to make the financial decision, then we used to generally call it as a financial management. Now financial management term has evolved over the period of time. So it's not that the term financial management has developed all of a sudden. So the whole genesis of financial management is very much historical in nature. And if we go by the term finance, then obviously we know that we are using the finance term from the nomadic ages, since the ages of the period when the people have understand the value of money, or the people have understand the value of exchange of trades. So from that particular point of time only the people have an idea about finance, and people have an idea about use of finance. Now whenever we are talking about the concept of financial management, we used to understand it from a very recent origin. We think it from a very recent domain. Now when we think about this, it looks over what? It basically looks over the procurements of funds. That means what are the various sources of funds, how we are going to generate the funds, what will be the sources, and from where we will generate the funds. But generation of funds is not only the important element of financial management, but it also includes the economic and prudent manner, that how we can able to make the optimum utilization of the resources. That means what way we can able to make the optimum benefit or optimum utilization of the resources. That is also the important element of financial management, so that the owners, whoever have invested the money, they get a decent return on their investment. Because we know that every investor, they invest in a business or invest in any kind of investment alternative with an intention to earn benefit, or with an intention to earn some return. Now if a investment does not generate any return, though investors would like to invest, so the return will be generated provided there is a most economic and prudent way of using that fund. So we are not talking about the financial management from increasing our return or increasing our income, but we are also talking about the concept of financial management from the perspective of making the best utilization of the resources. So the term financial management is very wider in nature. It's very much broad in nature, so we have to understand it from a in a very larger scale. Now, when we are talking about financial management, so we have to look over the what is the evolution of financial management, or what is the scope of financial management, how financial management has developed over the period of time, how it has evolved over the period of time. Now, whenever we are talking about the scope of financial management or evolution or history of financial management, there are two approaches. One is traditional approach, other one is modern approach. So when we are saying traditional approach, we are talking about the phase before 1940s. That means when we are talking about the phase of traditional approach, that means we are talking about the period when we have before 1940s. Now if you look over the concept of financial management, we can able to say that this topic has got more prominence after industrial revolution. So why industrial revolution? So as we know that industrial revolution has happened in Europe, and after the invent of the steam engine, and after uh, after the British colonies or British or French uh, people, they tried to control over different economies. Their intention was to acquire resources. Their objective was to generate income from different sources, and for that, in the search of their sources, they have invaded different countries, they have ruled different countries. Now what they have done by that way, they have acquired the resources and they have used those resources in their industrial development. Now by that way, before 1940s, most of the time these resources were generated from colonies. So colonies used to give resources to these rulers or these ruling countries. But by the time 1940, most of the countries, they had their freedom struggle, and majority of them got their independence. And if we talk about India also, India got independence in 1947. Now after that, the resources get scarce for these countries, so obviously the concept has changed after that. Before, whenever these ruling countries, they need any kind of resources, they used to bring it from their colonies. But after these economies got independence, or they freed from the ruling countries or from the rulers, uh, the resources become scarce, and definitely the concept changed there itself. That means how we can able to make the best possible use of the existing resources. So that's why when we are talking about traditional approach and modern approach, these two phases are in fact divided into two timelines, one before 1940s and after 1940s. Now if we talk about the traditional approach, or if we the concept of traditional approach, what traditional approach basically talks about. Now traditional approach actually basically talks about only about the procurements of funds. That means when we are talking about traditional approach here, the financial manager or the manager, he or she is going to look over for procurement for funds. That means what are the different sources from where the funds could be generated, or what are the areas or revenues from where the funds can be generated, so that the financial needs of the corporate enterprise could be met. That means whatever the financial needs of the corporate enterprises are there, whether it can be met or not, or to meet the financial needs, what are the different sources from where the company or the industry or the corporate sectors could generate the funds. So the basic idea of financial managers at that point of time is that they want to raise the money, whether internally or externally. Their intention was to look over for the various avenues or various sources from where they can generate the funds. So their intention was to generate not only the fund from internally, but also externally. So the raising of funds is the prime objective in the traditional approach. So the focus in traditional approach was not given on the utilization of funds. So how we are going to utilize the funds, that is not basically given more priority in traditional approach. Now, when we are talking about the traditional approach, then these funds are raised, and these different sources are utilized, and these different sources are made available to the corporate needs and corporate requirements. So, the whatever for whatever purpose the funds are required, whether it is expansion, whether it is diversification, or whether it is increasing the structure of the business, or for whatever the reasons, the the basic solution the companies used to have, or the corporate enterprises used to have, whenever they have any kind of fund requirement, is that they will look for the different sources of funds or different areas from where they can able to generate the funds. Now, there are certain elements which we have to be look after into this particular aspect, traditional approach. Now, what are the, there are certain limitations. What are those limitations are? Now, traditional approach, it basically focuses on procurement of funds only. That means it basically talks about that what are the different sources of funds and where from the funds will be generated, what will be the avenues from where they can able to increase their sources of funds. So their prime focus is only on the procurement of funds, and they don't used to consider, or they fail in in from the perspective of allocation of funds. That means they don't give too much priority on the allocation of funds. So traditional approach lacks there itself. Traditional approach does not consider how we are going to utilize the funds. It only considers that how, where from we are going to generate the funds. So here the basic idea of the traditional approach is that it only deals with the outsiders. That means they used to look over for the different investors, bankers, from where they can able to generate the money, or from where they can able to generate resources for the corporate units. So that is what the idea of the traditional approach, and there lies the limitation of the traditional approach. Now, traditional approach is internal decision making is completely ignored in this approach. Why? Because whenever we are talking about corporate financing, nowadays we talk about in a very different way. But when we are following a traditional approach, we are basically not looking over to the internal elements of the business. We are not talking about how the funds are used, or where the funds are used, whether the funds are sufficient or not. That is not a priority in the case of traditional approach. Rather, we will look over only for the sources of funds, that where from we will generate the funds. It is just like that someone is getting money from outside, and without looking into that how that fund is utilized inside. So if we don't know how we are using inside, rather than that looking over to that element, we are looking over that where from we are generating the money is the prime focus in the case of traditional approach. Now because of this particular approach, there is a problem with the working capital management. So working capital management becomes is a little bit complicated in the case of traditional approach. Why it is complicated? Because traditional approach does not look over to the utilization of funds internally. So when it is not looking over to the utilization of funds internally, obviously the concept of working capital management fails there. Because when we are talking about working capital management, means the management of funds which we require for day-to-day purpose. Now, if we are not concerned about our financial requirements on a day-to-day purpose internally, then obviously the concept of working capital management does not considered here. Now, that is the reason why actually the traditional management or traditional approach system has not able to gain prominence in today's corporate world. In today's corporate world, the traditional approach is a very much redundant approach. It is not basically used because of its own inherited limitations. So here the only point which the traditional approach, those people who follow the traditional approach, is that they used to look for the supplier of funds. They always see that who are the where from, or how much amount of money they can able to generate from the different suppliers. That is the basic prime focus this traditional approach method or traditional approach used to have. Contrary to this, there is a modern approach. Now, modern approach, when we are talking about, it is post 1940s. So after 1940s, in fact, the concept of traditional approach has been changed a little bit. So why it is changed after that? Because after 1940s, few people, they have developed certain theories on management, and these people, they have not only given they looked into the financial success of a business in a very different way. They have seen, they tried to understand that how a business used to get successful, whether it is because of sources of fund or whether it is because of the proper utilization of funds. So they have looked into a very much analytical way. Their approach was very much analytical, and they have developed different type of theories. Few of the theories, if we talk about in that particular period, was suppose portfolio theory, then we have Modigliani Miller theory, then theory evaluation of firm. All these concepts were developed in that particular time only. And even the concept of management accounting also came in that particular period only after 1940s. So this phase has given a very new dimension into the utilization of funds, or into the finance area, or into the management of finance. So here now, in a modern approach, what we used to do, it was not only the acquisition of funds as well as the allocation of funds for the various uses. So when we are talking about financial management from the modern approach point of view, or from the modern phase point of view, then we are always talking about that it's not only about the way we are generating the money, but also about how we are using and allocating the funds for different uses. So if we are not concerned about the allocation of funds in a best possible way, obviously the funds are not going to generate return for us. So here the issue is given on issue of evolving the raising of funds and efficient utilization and allocation of funds. So these two elements are taken into consideration in the modern approach. In case of traditional approach, we are just only talking about raising of funds. So because of that the internal management was not important, the proper utilization of fund was not important, allocation of fund was not important. But after 1940s, when modern approach has come up, the concept has changed. Now it is looking over not only to the raising of funds or the sources of funds, but it was also looking over to the allocation of funds, and that too again efficient and proper allocation of funds and utilization of funds has become a norm of the business nowadays. So in a situation where business world is getting very competitive, the business market is getting very open, and what I will say, there is a large number of competitors coming up into the market. Obviously the sources of funds are getting very much restricted. Now the sources of funds, the areas or revenues from where the funds could be generated, it is getting very much limited. So in that particular circumstances, if a business has to survive, then the business has must have some ways of maximizing the profit. And one of the ways of maximizing the profit is that if the business can able to control and exercise efficiency in the utilization of funds. If a business can able to do that, then obviously the business can able to earn more benefit, and subsequently because of that more benefit, the owners will get a maximum return. So, what roles a financial manager has to play in the today's world? So, the financial manager is definitely concerned about not only the looking over the finance part, but he is also responsible for the overall financial planning and control. Now, when we are saying financial planning and control, obviously we are talking about the internal element. That means how we are going to use the funds. There are two concepts here. One, the funds are coming from outside. So that is one. These are the different sources of funds. And the second is how we are going to use the funds internally. So these two elements must be in harmony. So because these different sources have some cost. The sources of funds or the fund generated from outside does not come free of cost. So it involves a cost. So to recover the cost, and apart from that to earn profit from those sources, definitely the proper utilization of or proper use of these funds are very much essential. So a financial manager has to look over to the different financial planning. It must have different financial control tools in his hand at disposal, so that it can able to generate more return for the entity. Moreover, the raising of funds, what are the different sources of raising of funds? Now we have different sources of funds: equity shares, preference shares, bonds, debentures, loans. So the financial manager has to look over that which type of source of fund is more beneficial for that particular corporate entity. So where from the funds are going to give more return to the business unit, that must be a priority for the financial manager to look into. Apart from that, once the funds is generated, then we have to look over as a financial manager about the different uh, types of fixed assets we require to run the business unit. So there are different type of fixed assets available. There are different types of assets which are mutually exclusive in nature. So selection of a right type of fixed asset is also very important for a businessman to look over. So which fixed asset is going to fulfill the need and requirement of the business is very much important to look into, and on the basis of that the amount of fund will be utilized in that. So when we are going for financial management, we are not only just going for the sources of funds, but we are also looking over that how we are going to select a different type of fixed assets or different type of assets where we want to invest. Apart from that, to run the business on a day-to-day events or on a day-to-day affair, management of working capital is essential, because if we cannot able to manage the working capital properly, that means the capital required for the day-to-day purposes, then again the financial manager will fail in his or her duties. So obviously a financial manager has to look over to that element also, that what are the different sources, where the funds are used, and how much funds is be required for a day-to-day purpose. Apart from that, our business always used to have a different type of financial events, financial situations and conditions, on the basis of which the financial requirements varies. So financial manager has to look over or keep a control over all those additional events and additional expenses and areas or revenues also, where the finance could be have some kind of impact into the performance of the business unit. So, in the process of doing so, a financial manager has to look over to certain things. First, what is the nature and size of the firm? That has to be looked after by the firm, and how this firm is performing in the overall time, and what are the functions of the business from the time to time, that has to be taken care of. Moreover, the financial manager has to look over the relocation of resources, then financing of these events, and how much cash is to be taken out, how much be reinvested. So these three elements are basically very much important in the case of financial management. So when we are saying that those which are resource allocation and financing, means this part is basically related to investment decisions. So every business needs some investment decisions. So when we are talking about the resource allocation, that means what will be our investment decisions, what type of asset is right for us, which asset is right for us, uh, whether whether investing in this asset is going to give more return, or the other another asset is going to give more return. So those type of decisions are very much important in the management. But apart from that, investment is not a problem unless and until we have a fund in our hand. So definitely we have to look over that where from the finance will be generated, what will be the financing sources, what will be the areas from where we will generate the funds, what will be the areas where from we will get the money. So we have to look over that which type of funds financing system is more beneficial to us. Depending upon that only we will look over to invest in different type of investment alternative. Once invested, once finance is generated, then invested, definitely it will generate some return. So once it is return is generated, then we have to look over that how much money we have to reinvest into the business, how much money we will withdraw in a form of a dividend or distribution of dividend, what we will do. So financial manager is now not only concerned about the sources of funds, that means where from the funds are generated, but also at the time the financial manager has to look over that what will be the various sources from where the funds could be generated and how it could be make the best possible use. So depending upon these explanations, we can able to say that financial management is basically classified into three functions. There are three basic functions. First, investment decision functions, then financing decision functions, and dividend decision functions. So these three functions are the prime functions or the prime areas of modern approach of financial management. So in a modern approach of financial management, we are not only talking about only the financing decisions, but we are also talking about investment and dividend decisions. But in a traditional approach, it was just only a financing decision, because the financing decision was only the part in the traditional approach. But in the modern approach, we are talking about not only financing but also about investment and decision, dividend decisions. So we will discuss about these finance function in detail in the next session.